So how to use the 1SD trend for its better success, that will be the agenda of discussion today. And as you know, every week we used to flag this particular report of weekly trend in our website. If you visit our website, and here you will find out one blue color link. So once you visit this, the entire 53 weeks, 57 weeks trend analysis you can find out. So this is a snapshot only the trend levels will be given. So if you want to download the PDF, then you just click on this, you will get the PDF report. So with every week's report, I used to give a complete analysis how the last week it has performed. So so far I am giving from the past 57 weeks it is being given. In the month of June this year, some 2 to 3 weeks I have postponed giving this thing due to personal reason. However, those weeks is not being counted here. We are being giving you from the past 57 weeks. Out of that 53 weeks it has triggered the success. What happened last week, that also I have given 24th, and follow-up emails also I have given in this regard. 24th October, the Nifty given the uptrend with buy with a hedging of 8750 put option. This has triggered the stop loss on 25th. Net loss was 1050. Post which it has given a, so as per this principle, once the stop loss hits, trend changes, we have to exit with loss and enter a fresh trade in the direction of the trend. So we have entered in the direction of the trend, and the second trade has rewarded 4,125. So net we have got 3,000 plus profit in the Nifty in the last week. Bank Nifty also similar kind of things has happened. Stop loss has hit. The amount of losses used to be bigger because of its denomination is higher, and volatility also used to maintain very high. And I used to advise you to go for the weekly options for hedging the Bank Nifty future. So first trade exited at a loss of 5,560. Second trade rewarded you 8,800, and this process also you made some 3,300 plus profit. So this is the performance of the fourth week of the October, which is expired yesterday, and the November first week, which is going to start, we have Monday holiday. So 1st to 4th November. So this date, Monday we have the holiday. So 31st is a holiday, 1st to 4th November. So this time, what is the trend we are expecting? So that I have calculated as per this one standard deviation formula. And this is a very simple calculation. I have taken the last traded price of Nifty future. I have taken the real-time volatility. Many of you used to ask me why the volatility taken by you is not matching to my calculation of volatility. I used to make it very clear here. So this volatility, what I am calculating using a process called GARCH, General Auto Regressive Approach, GARCH method. Using that I am calculating it, and using this particular volatility along with the future I have made it. And this volatility calculation of GARCH cannot be done in a Excel sheet. It has to be programmatically simulated with lot many variables. So for that it is little technical in the aspect of programming. So that's why that is not a part of our financial analysis subject. So this is how I got a volatility of Nifty, and 7 days I am taking. Why I am taking the 7 days for 1 week? Many of you also asked me, instead of 7 days, why can't we take 5 days? Why can't you take only number of working days available in that particular week? This 7 days is being considered because in the financial domain, the holidays, leave days, weekends, everything, your money has a value. So if you put 100 rupees on your bank, so bank doesn't say you will give you interest only on working days. Bank give you interest on holidays, bank give you interest on vacations also. So if you take loan from any bank also, similar way, you cannot argue that yes, I'll give the interest only on for the working days. So money employed in any business has a value, whether irrespective of it is working day or strike day or holiday. So for that reason only, this 1 week's duration of 7 days I have taken, and by this formula only it is being calculated. This is being divided by 100. Reason, it is a percentage, 10.61%. I want to make it to the decimal form. That's why I am dividing it by 100, multiplying with the square root of 7 days is constituting 1 week. So that's why I have done it. And the entire result divided by 365. This is only giving me the price range. After getting the price range, I am using the Fibonacci ratios, multiplying with the price range. I am getting whatever the Fibonacci ratio price range. I am just adding from with the last traded price or subtracting from this last traded price to identify the uptrend and downtrend. And I am advising you to make an entry at the uptrend crossover point or the downtrend crossover point. This is what the entire process is doing. And in fact, once this process is doing all this thing, I have given a detailed description how to use it. I have also written here very clearly on Monday or during any point of the week, if it crosses 8699, this is the uptrend crossover point, then buy it with an 8600 put option long. So why this behavior of choosing a option strike I changes over the period of the month? Because you are in the first week of the settlement, most of the options is a very high priced, premiums are very high. So that's why I am just recommending a strike which is very close near to the downtrend price. Once you close near to the expiry, and especially on the expiry week, I used to advise you go with the just in the money options. So that is why I used to choose the strike. I told you to purchase along with a put option. If it achieves the first target, then trailing stop loss you use. So first target 0.618 I am fixing it off, and trailing is 8717, 0.382 is trailing. Second target is 0.786, and for that 0.5 retracement is the trailing. Third target, once you come, it is I am bringing it to the 0.786 as a trailing. Why this trailing rule I have fixed it up? This is as per the Fibonacci principles internal. Most of you would have observed Fibonacci principles, this 0.618 to 0.786 known as the death zone, means from this price range trend change used to happen after maybe touching the second target or in between the first and second target, trend change used to happen. But if successfully it has crossed that level, then 0.888 and 1.236 used to be a possibility for that month. For that reason only, once it is in the first target, we are just keeping little distance for the trailing stop loss. Yes, we are hopeful it will go for a second target. Once it go for a second target, we are just trailing it to 0.5 level, so that at least few points below the first target I should put my trailing. And once it goes to the third target, we used to say that yes, trend has matured, it has rewarded what is the best possible reward it should give it to me. So for that reason only I am just bringing the trailing stop loss towards little near. So this is just a swing trading style of mine which I have just given to you. You can adopt any style of your own. Nothing wrong if you are putting stop loss or trailing stop loss as per your wish in between this 0.5 and 0.618. Any logic you follow, if it is successful, you can follow. So that is how I have just given you the trend here. One thing I used to write here, and many times you people have asked me, If your trade is with a hedging, I've told you here, if your trade is with a hedging, then option hedge future and you reach a stop loss, do not quit in hurry. Better wait for a conclusive crossover of 0.382. This is also a concept of Fibonacci. So Fibonacci principle, many times I have taken this webinar. You can find those recordings in our website. The exclusive webinars on Fibonacci, I have told you that this is in Fibonacci principle, 0.236 is sets the trend, 0.382 confirms the trend. 0.236 retracement or 23.6% retracement sets the trend. 0.382 or 38% retracement confirms the trend. So for that reason, if you buy at 8699 and you have come to 8639 level, trailing means the stop loss has triggered, but you have a hedging, it is protecting, giving you some amount of profit loss back. So in this case, instead of hurriedly quitting this trade at this point, little wait and wait for the price to penetrate below 8620. Because you can enter a trade till 8605, that is nothing wrong in that. Till 0.5 retracement also you can enter a trade. Trend change once happens, it has a very high probability to penetrate till 1.236, even 1.618. So nothing to worry about that. So once this level penetrate 8620 level, that time you should quit and come. And sometimes what happens, some news outcome will be there, some kind of external events will be triggering this kind of trend change. That time I used to say that you please wait for the conclusive session, 3 o'clock to 3:15. But if it is a huge gap down and other things, you cannot help it out. So you may sacrifice something, but in case of a quiet market, nothing wrong if you can wait for a last hour of trade, but that part makes it very complex. Leave it off and just stick to this idea. Once the trend change happens, instead of hurriedly quitting the trade, wait for a 0.382 penetration. Once it comes, you can come down. So this is how you should utilize this particular trend report for your best benefit. And hedging is a must. You must ask me, some people also has given me the means the email wherein they have just asked me, is it wise to hedge the trade at the very early stage of entering the trade? Why can't I hedge the trade means once it gives me a failure or once it comes to the failure point, what you can achieve out of that? So question is, if you hedge a trade after stop loss triggers, then what you are going to achieve? The purpose of hedging will be lost. This purpose of hedging will be lost. So for that reason only, we need to focus on the purpose of hedging is to protect my current position, not to protect what is the future outcomes. I'm not going to carry this trade post the trend change. So why should I hedge once it comes down to 8639? So don't do that. Once you enter a trade, hedge it. So that is some people used to tell me. Some people also used to tell me hedging reduces the profitability, then why should I hedge? But profitability reduces, but you can just think here, last week's trade, Nifty future you lost 58 points, this option given you 45 points. So hardly 13 points you have lost. Instead of 58, you lost only 13 points. So in proportionate way, if you can see, it has protected more than 80% of your loss, it has recovered you back. Though it has taken, instead of here profit of 111 point, you could have 111 point profit, you have just got 56 point. That is not a problem. But when you start protecting your losses, your portfolio will be healthy. So do not always think about the profit, think about the adversity in a trade. That is why we used to hedge. So adversity is very important. Here you can say 300 points instead of some 10 to 11,000 losses, you have just incurred 5,500. So 50 to 60% it has protected. So when the loss comes, if it is protected, to an 50, 60 or 70%, that time the portfolio used to be very healthy. Your trade habits used to be a refined habit. So for that reason only, it is always advisable to hedge the trade. Without hedging, if you trade, your overall performance over a period of time, used to fall down, and used to, if you see at the end of year, your profit will not be positive if you do not hedge. So hedging is must for a better performance of your trading habit. That is must. And some people already, I have also sent you an email earlier in this week. I have asked you, some people say that I have started the trade with 1 lakh rupees and I started losing. Then after, once my capital has reduced to some 50,000, I thought that I should trade in commodity or only in options. I have asked you a plain question. Is it a good suggestion to, after losing 50% of your capital, you are just changing the instrument from future to commodity or options? So whether your problem of losing a trade is being solved by this process? No. Just by changing the instrument, how your success will be guaranteed, how your success is going to reflect. So if you just change your habit from future to commodity or to a only option, what happens? The remaining 50 also will go out, because you have not learned why for it is failed. Because most of us used to lose the trade because the trend calculation what we follow, it is wrong. It doesn't perform. It is, I cannot say it is completely wrong, but it doesn't perform. What we expect from that calculation, we never get it. So that is why, or that is the reason why we used to fail in the trade. So 1SD, why I used to advocate, it has given a true indication and it has given a true performance. Look out this 24th to 27th October 2016. Why to look out all old data? What happened last week? Just see here, if you just look into this factor, 24th to 27th, this is the duration. Though one of the Nifty trade failed, we entered, we made some money. Profit and loss analysis is a different subject. But during this week, 24th to 27th, what is the low it has created? 8546.85. This is the low it has created. What was the calculations for that particular week? So this is 1.236 retracement target is 8552. Couple of points below it has gone, settled down, it has bounced back from there, it has gone to 8630 or something and just settled there on the day of expiry. So see the close approximity of your calculated point which we have done 2 days before the market starts for the week, and the close approximately of the target what we have achieved. Similar things also you can see for the Bank Nifty. Bank Nifty also you can see this is 1.236 target is 19,276, and if you just compare it with the last week what happened in the Bank Nifty, I'm just taking from the NSE site, it is not being manipulated by me. What has happened in the market, that only I am showing you. 27th of October, it has gone to 19,245. So one of our calculation point 1.236 retracement level which we have calculated for that week was 19,276. We have gone till 19,246. Close proximity of the lows, the highs, the closings. If you compare the close proximity of your highs, lows and closings of Bank Nifty and Nifty, which we have calculated much before our advanced calculation we have done, that validates this method. It is not a person validate. It is not that Ranjan validates this. Or I am not going to change these readings. Today I have given you this, and Monday you will find out this 38 will become 33, or this is 20 will become 50. So this is a pure mathematical calculation. It has valid inputs for the taken for the calculation, and it has transformed. So this is what we have done. So nothing is a secret here. Everything is open and clear here. So many, those who wants to copy that things, they want to say that you tell me, teach me the GARS method and this thing. That is not, that I am never going to teach you, because you learn from your things. So GARS method gives me a correct estimation of volatility. So that is the key to this method. You can utilize the GARS method and calculate, but do not utilize me to teach you for the GARS method. Because the brand behind this particular method is the correct estimation of the volatility. Fine. So this is how we should calculate and utilize. And one very simple thing I just wish to tell you here, how we can make use of these things for our option strategy. Many of you will be saying that no, it is very difficult, very cumbersome to implement the option strategy. Very simplest way I'll tell you. Suppose you got a uptrend confirmation at 8,699 for the 1st to 4th November. You are expecting maximum it will go to 8,875, 8,700 to 885, 175 point gap is there. If instead of entering the future as an option strategy trader, if you are just buying an 8,700 call at that particular time, when it is this call you are buying, simple bull spread, and you are expecting that it will go to 8,875, you are selling on 8,850 call option, 8,850, because this is final target is 75. Call option, one lot you have bought, one lot you sold. By this process, you have formed a simple bull spread when the uptrend has given. Risk reward, look into this part, because this most of you used to ask, what is the risk reward? 8,700 call option, which is at 108, and 850 is 50. So 48 rupees. It is having 60 rupees of risk between these two strikes. 850 is 48. Yes. So between this particular strike, you have 150 points of difference. So all in all, you can say in this order, if I buy 8,700 call buy at 108, 108, and if I sell 8,850 call option, because my last target I can call option sell, if I sell it at 48, so my total risk in this trade, if market doesn't perform and I lose money, this is the maximum loss I can get, 60 multiplied with 75. But if I win this trade, so 150 points difference between 8,700 to 8,850 minus this is 60. So if I take it out, 90 point I can win. So this is 1:1.5 risk reward ratio. 1:1.5 risk reward ratio. Not only this, you can also form many type of option strategy. Not only this, you can, in the first week of settlement, you can form any covered call strategy also. You have uptrend crossover given, buy a future, sell a 8,700 call, or sell 8,750 call, because first target you are going to achieve 8,750. So 8,750 call option and buy one 8,650 put option. So forming a covered put with the covered call with the put option also recommended. If the downtrend gives, similar way, sell a future, sell a put option of say 8,600 and buy on 8,700 call. So by this process also you can manage the time value decay in the option in a very effective way by converting this same thing to a covered call, covered put, simple bull spread, simple bear spread, no need for any hi-fi advanced option strategies or hybrid option strategies. Simple strategies forming a saddle, strangle, calendar, gut or iron condor in this crossover points can reward you also. You don't require any advanced strategy. Whatever basic 30 strategies are there, out of that pull out any 2-3 strategies, start implementing it. So by that process what happens, you will be doing a better money management of your trading portfolio. When you implement the option strategy, you do a better money management of your trading portfolio. And this is how the trade means the trend of Nifty and Bank Nifty performs. And this same level you can get it in our means software also. And this same level of accuracy, the one standard deviation gives in the intraday trade also. Intraday trade, those who are using it from the past 1.5 years, many of them has given their positive feedback stating that similar result it gives in the intraday trade also, but if they ignore hedging they used to be punished sometime. So intraday if you enter also, start adopting hedging as a standard healthy practice of your trading, then also it will be rewarding. So one small announcement I just want to make it here. Most of you will be knowing about our product, and those who are the newly coming for this event, they may not be knowing about the product. We have this 12 different products which has different objective it is being formed, and those who want to learn option, there is a product. Those who want to learn intraday, there is a product. Those who want only software, there is a product. So 12 different products are there which consist of 6 printed books, all our DVDs, near about 16 DVDs, cross moving about near about some 40 to 50 hours of audiovisual lectures, and includes all our software, pair trading software, option strategy software, intraday software, positional software, many things. But now recently we come with one more plan. Over this period of time I have experienced that many of you, those who invest in our product, used to find out little difficulty in grasping those subjects, find difficulty in implementing those particular concept in your trading, and used to find little difficulty in maintaining the consistency of those methods in your trade, because you could not able to understand that concept purely. For that reason only sometimes it results that though you know it is a valid method, but sometimes in between you used to discontinue it and think that it is very hard stuff, I cannot able to digest. So for that I have come with a very elaborate program. It's a 1-year program. We have designed it in the 6 phase, and it is not going to burden you lot of in the studies and all. So every month we have fixed a small objective for you, very small objective. You will be learning very little per month spread out over 12 months. So what you are going to, how it is going to benefit you. And this program is only for our buyers of the full package. Those who bought, invested in 17,500, they are eligible for this product, or those who are going to invest for their learning, they are eligible for this product. Others are not eligible because it includes a course component which if you do not have, you cannot able to follow it. So for that reason only it is a restricted program. So here you will be learning only one technique of technical analysis. You will learn only one hedging technique per month, one technique for investment, one technique for day trading, which you can able to utilize. And these techniques you will have a live mentoring, means every month first Friday will be, I will be devoting 1 hour for you in the morning to explain you those concepts, what you have learnt during that particular month or what you are going to learn in that particular month. And one day we will be discussing exclusively on the how to utilize this concept in our software. This is a 6-phase learning program we have just made it. It is not a pure learning program, rather it is a mentoring program wherein you can utilize the concept learnt by you in the practical market. So it is every month we have just scheduled it. January what you are going to learn, February, and it is going to start from the November, from the coming month. And it has a cost component. Those who have already bought our courses and software, full package only, for them it is 6,000 till 30th of October. Once the first batch is filled, it will be increased to 8,000. So first batch, one small number I will be taking. So once that first batch is filled, it will be increased. And this, those who are newly going to enroll, they are paying it as a 17,500 for the courses and 5,000. So 22,500 they need to pay. And if this is valid for till 30th of October, post that this is also going to be increased by 1 or 2,000 after the first batch. It is only an inaugural offer for the first batch. So since it is a year-long program, our infrastructure cost is very high. So just to start off this thing, I given you a inaugural offer for a limited period of time. So this is also being transparently given what you are going to learn in every month. So the objective of this particular program is, yes, you have 6 printed books, you have 72 hours of DVDs, you have lot of stops. But you are thinking that from where I should start, what I should implement, what I should not implement. If I implement and during that process I meet with any problem, who is going to hold my hand and teach me that whether I am right or wrong? So these are the things will be eliminated through this process. It is just an interactive program wherein your interaction with smart finance will increase through this program. Once your interaction increases through this program, besides this program also the email supports will be open to you, not telephone supports. You may be thinking that I have just enrolled for the program, so every day I should call and talk to Mr. Ranjan about my intraday trade and all. That is not there. The ethics of program will be lost in that. So here email supports will be there. Monthly 2 times you have the opportunity to discuss your problems and difficulties with me. Along with that you are going to learn specific things and experience some things. And you are learning very little content every month, spread out over 12 months, so that it should not burden your study, or maybe you may be in a different profession, or maybe having a different education background, maybe you will be having a different work responsibility. So without disturbing any of your activities, this program is going to train you over a period of time. You may not get the result in the first day or first month of your joining. Maybe the actual result or impact you will be realizing after 2 or 3 months of this program. But once you complete this 1 year's program, I'm sure that it is going to make you a professional trader, not a greedy trader, because greedy trader and professional trader having 2 different definitions. Greedy traders every day needs money, but he never get it. Greedy trader every day comes to the market, that chase it, get a very high amount of profit, which never happens. Second is a professional trader who is consistent, who wants that particular, he wants to learn a perfect method, wants to implement and experience the success and carry forward that experience for its future use. So that is very important. You experience a success, carry forward that same experience for your future success. So that makes you a professional trader. So this is how this program is designed, and this is only for the full package buyers, not for only 1SD buyers or any individual product. If you have bought, you are not eligible for that. Reason is it involves a amount of text reference. If you do not have those documents, you cannot refer to those concepts. For that only it is being restricted. So this is how you should utilize next week's level for the Nifty and Bank Nifty. And Bank Nifty levels, I have also told you that once the trend crossover happens above 0.382, trend confirms, that time you should enter and try to hedge it with the weekly options. And while hedging it with the weekly options, try to write some option also, weekly options, because it has a very short lifespan. So if you sell something, it rapidly decays the time value. For example, if you are for next week, if you are buying Bank Nifty at 19,800, I am suggesting you to buy 19,800 put of 4th November expiry. Same time, nothing wrong if you can just some 20,000 call option, you can sell one lot. So if you can sell one lot of 20,000 call option, it overall reduces your cost employed in the 19,800 put option without compromising with the profit. Without compromising out with the profit, because you have a 3 level of profit sitting in your hand. Same time your put option is being taken at a lesser cost because of this writing of an option. So by this process also you can reduce a lot of cost. So this is also you can implement in some of your strategies so that it will be much more rewarding. Or you can think of a hedging that option with a buying side of option which is having monthly option. If you buy, suppose if you buy a future 19,800, imagine you are buying a 19,800 put option of the November 24th expiry where you pay heavy amount. So in that case, time value decay proportion will be lesser, and nothing wrong if you can sell on 20,100 or 200, whatever the money comes of that call option of the weekly options or the next week options. November 4th we are expiring, you are buying, suppose I'll make it more little more clear so that it will be this is also a very fantastic strategy. Buy Bank Nifty, suppose 19,800, it is only for example. Imagine it is given uptrend, we have bought it. Buy Bank Nifty future, and simultaneously we are buying 19,800 put option of 24th November expiry. So monthly option, it will be having some value. So imagine that time we are buying it at 300 rupees. 300 rupees. Same time, nothing wrong if I can sell 120,200. So if I November 1, if I am selling November 4th, maybe I will be having lesser. So last target is 20,289. So instead of this thing, if I can just go for 20,300 or 500, 300 call of say 4th November, followed week will be different. So the following week will be different. If you choose Bank Nifty, we can come to know what is the 10th November. So if you can sell on 10th November expiry, then that also makes some sense. So this is 3rd November, we can go for 10th November. Little lesser liquidity will be there, however it will be trading. So 20,000, 20,500. So this is only 20 rupees it is trading. We can go for some 20,200 or this thing which is having a sizable amount, 85 rupees it is there. We can think of in that prospects so that this selling of the 20,500, so suppose 20 rupees. This 20 rupees only to reduce the cost involved in this 300. That also you can do. Means instead of looking into that particular week, you can think 1 week beyond, so that you can able to little reduce the cost. But since these are the weekly levels, it doesn't make a sense to hold a longer term options. Better is short term options. In short term itself you solve this, means solve this particular issue, so that it will be better. You can think of having a in the money options. That is also another trick you can follow. Suppose 19,000, because weekly options you are going to do. So if you buy, same thing, if you buy Bank Nifty future at 19,800, so just instead of 19,000 buy Bank Nifty 20,000 put option, 20,000 put option of 4th November. So which will be having very lesser time value because of its intrinsic addition. So 3rd November, if you just see 3rd November, 20,000 put option, 400 rupees it is trading. However, the future 400 rupees it is trading, wherever this is future is at 650. So 650, but it will be evaluated based on the spot price. So at the day of expiry, so your 600 is the spot, and you are just 400 rupees it is trading, 428, only 28 rupees of time value it is there. So 28 rupees of time value, once this price goes to 20,000 range, this 28 rupees of time value may become 80 or 90. That time also you can make some good profit, or else if it fails, only 28 rupees is your loss. So time value component will increase once the intrinsic starts decaying. So that principle also you can follow in the Bank Nifty weekly options. So these are the very small strategies. If you start implementing, it makes a great sense in your trading. But start implementing. If you do not implement, then you may be doing the first choice, lose money in the future trade, shift it to commodity, then shift it to options, lose everywhere, then get disappointed. So that is not a correct solution. Correct solution, start hedging, start protecting. If you find that hedging little difficult, take your time, study the basic principles of hedging, study very simplest principle of call and put options, start implementing it. It will slowly you can able to learn this concept. So this is